Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we're going to talk about a company that we have never spoken about, I think, in this channel. So I'm going to bring that to your attention. As always, please do your research, find out more information about this company. I do not own this company at all. I'll tell you exactly what I think at the end of the video, but for now let's get started the video. But please, before we do that, like the video, subscribe to the channel if you haven't already, and join us in the Patreon account where you get access to all of these things. Inshallah, it will cost you about 15p per day. Now, overall markets are doing okay so far. A year to date, the S&P 500 is up about almost 12%. Last 6 months about 16%. Just this month is actually up about almost 8%, which is quite nice to see. And their earnings reports is going okay so far. There's a lot of companies that have reported so far, but next week we've got quite a few companies reporting. So companies like Palo Alto Networks and Zoom and so on are reporting on Monday. Tuesday we got Macy's, Lowe's and so on Tuesday. Wednesday, Target, TJ X as well. This is one of the companies we're looking at soon, inshallah. I've done a little bit of research. I want to share that with you guys very soon. And then we have Nvidia on Tuesday, basically Wednesday afternoon. We also have Snowflake. We'll see what Nvidia says. You know, if this hype of the AI situation continues to, go higher and higher, it helps the company to go higher, or if it comes back down to earth, we will see what happens, inshallah. Then on Thursday, we got Medtronic reporting. So that's the one that I own in this portfolio. And after the close on Thursday, we have Intuit. So it will be interesting to see these two companies. They haven't reported yet. So I'm excited to see what they report. And inshallah, hopefully that we will get an opportunity maybe to add to Intuit, because so far it's gone up so much in the last few months. So it will be interesting to see where we are. Now, let's get started with this video. So one of the things I want to do now is just kind of give you an overview of the company that we're talking about today first. And then, of course, as always, please do your own research. And this is the company, FactSet Research Systems. This is one of the data analytical companies out there that helps the investment world. So they are basically do a lot of analytics for the investment world. And currently, as you can see here, they have a market cap of $17 billion. So they're not a really huge company. And a year today, the company is actually down 6% when everything else is actually up. For the 1 year, they're up about 13%. And in the last 6 months, they're actually down almost 2%. And then just 4% up just for this month, which is quite interesting to see. So I'm going to give you a little bit of information about the company as always. And then, of course, like I always said to you guys, please do your own research. As you can see, they reported the earnings very recently. I think it was in March of this year. So as you can see, the revenue is actually growing 6%. Organic revenue as well basically grew about 6%. The operating income about 7.5%, and adjusted operating income about 9.8%. And with regards to operating margins, 47 basis points, and a net income 7.1%. So it grew about 7.1. Adjusted net income of 10%. And when it comes to adjusted diluted EPS, it's about 11%, and this is about 8%. Now the free cash flow actually has declined about 17%. So in terms of expectations, so this is what they've reported in terms of expectations. So when they reported, they actually missed the revenue. As you can see, it was up 6% year on year, because that's what we've seen here, right? But they actually missed the analyst expectations, which was basically they missed it just about 1.43 million in terms of their top revenue, but they beat, of course, EPS, as you can see there. Now, the other thing that we're really interested is the rest of it was fine. The organic, when it comes to annual subscription value, which is basically, again, this is one of the companies that have a subscription model. Again, I like subscription models because that means a client that actually stays with you no matter what happens. Of course, sometimes it's easy, if it's business is very sticky, very sticky if you like, then it will be more difficult for clients to move to another company. So if you have a subscription model and basically people that are using your data stay with you, most likely will stay with you for quite some time, because that switching cost will be quite high. Now, in terms of expectations, is in line with what the company has basically said. So this is a kind of summary of what is basically the company has reported in here, which is basically they're expecting about 110 to 150 million for the next one. Revenue side of things, basically 2.2 to 2.2 again, just about over 10 million over, and operating margins of 32% to 33%, or adjusted operating margin of 36 to 36.7, and so on. So this is basically what they kind of summarize. So looking at this, it looks like basically everything is heading in the right direction. There's not much huge drop in terms of price, in terms of the revenue and the EPS and expectation moving forward. So it'll be interesting to dig deeper into this company and find out, you know, where the company has been over the last whatever years. So just to kind of quickly look at the revenue side of things, I just want to see if the revenue is actually growing. So you can see here, free cash flow per share is growing. Sales has been very choppy. So as you can see here, that we've had, you know, years where basically it's gone up and then it's gone down. This we're talking about sales growth side of things, but right now they're expecting about 7% in the next 12 months. But when you look at the total sales, from less than $1 billion to right now $2.1 billion in terms of revenue side of it, and they're buying back their own shares, which is quite nice. So let's get started and look at the financials for this company. Is actually in the financial sector. Annual subscription and value and incrementally gaining market value, basically shares, is the main investment theme for me. The annual subscription value is really important. Like I've always said to you guys, you know, that's something that I look for companies, because that means they will have a repeat purchases from these customers. EPS current price is 448, EPS of over $12, market cap $17 billion, and it has a narrow economic moat. Beta is quite low, which is quite nice to see. PE right now about 35, forward PE of 27, and a 5-year average of 30. So that means it's currently trading slightly higher than where it's been in the last whatever years. And as you can see, the sector, normally financial sector, is very low, but in the S&P 500 we're looking right now at 24. Price to free cash flow right now we're looking about 28 PE, and price to free cash flow, annual dividend of basically right now almost 1%, but you'll get $3.92 for every share of this company that you own. Payout ratio 26%, latest increase was 6%, and the 5-year growth rate of 9%. Dividend growth history of 24 years. So this company will become a dividend aristocrat if basically it starts increasing by one more year. Dividend safety 95%. Free cash flow right now we're looking about over 600 million. So not a lot, but remember the company only has a 17 billion market cap, so it's quite small. Free cash flow yield of 3.7%, which is quite nice. Free cash flow margin of 29%, which is really good. Profit margin 28%, operating margin of 33%, return on equity 28%, and return on invested capital here about 19%. They have made it total return in the last 10 years about 16%, which is really good. Revenue growth we're looking at about 9% in the last 5 years. EPS growth of 12%, which is really good. Current ratio is way above 1, which is nice, and double-digit growth expected for the next 5 years. To me, that's really important moving forward. And as we know, current price is $448 per share. Morningstar is actually saying it's fairly value right now. 300 and let's call it 400 is what they expected. Same goes for basically not same, $353 per share when it comes to simply Wall Street, and that's 23% overvalued right now according to them. Tip rank is actually saying it's about 480, that's about 6%, 460, that's about 6% upside from where we are. It's a hold according to them. Same goes for Seeking Alpha, 451, almost a 4% upside from where we are, but it's still a hold for them. Now in terms of Sharia compliance side of things, we're looking at about no issues with this one. In terms of business side of things, it's less than 5%. In terms of interest-bearing securities, less than 30%, and less than 30% when it comes to interest-bearing securities and interest-bearing debt both. Now, they are buying back their own shares. We've seen that already. So really solid business overall, and it's one of those things that you don't really do more. Basically, you don't really see anyone talking about it, and I really like this. Like MSCI's and S&P and Global and Moody's and all of these companies, they have more or less monopolized the markets that they're in, and they are really good businesses. And if we look at how this company has performed over the last whatever years, so just to compare it with the S&P 500 to see if this company actually gives you more or less the same returns as the S&P 500. So the last 5 years you would have made almost a 69% on your money, 85% for the S&P 500. So not huge differences, about 10% give or take. 356% in the last whatever 10 years, but the S&P 500 only 100 and let's call it 180. So really beat the market when it comes to the last 10 years, but everything else seems really good, and I really like the business. So let's now look at the earnings moving forward. Almost double digits every single year when it comes to revenue side of it. Year-on-year growth is of almost 10% in terms of EPS, which is very decent. And then when you look at the revenue side of things, we're looking at about year-over-year growth of about 6%, 6%. So solid, absolutely no issues with that. And like I said, you know, they're growing the dividends, if you like, almost about 6% every single year, which is quite nice. Sorry, 9% of the last 5 years, basically 17% in the last 20 years, which is really good. And the fact that their payout ratio is only 26%. So yeah, so really good business. I like the business model. There's a lot more information you can find on their website. So you've got basically the forecast for the business, how they've done this is basically the latest revenue, the latest report that they've basically reported. And yeah, different segments. So just learn about the different segments, the subscription model, and look at this. So more than 97%, 95% in terms of annual subscription value retention, basically. So this it says the ASV return from clients over the last 12 months, which is really nice to see. So I really like this type of businesses that have a basically kind of recurring revenue. They have those subscription models. People are coming back to that company because they are the company of choice for them. There you go. So I'm going to stop the video here. I hope you enjoyed this type of content. It takes a lot of time and effort to put these things together, so I would really appreciate if you can join us, the Patreon account, where you get access to a lot of these things, and it will cost you only 15p, and at the same time it really helps the channel. Have a wonderful day. Assalamu Alaikum.